Let me tell you exactly what happened this week, and I need you to understand that everything I'm about to say is real, documented, and somehow not the lead story on every financial news channel in the country. President Donald Trump touted Palantir on Truth Social after buying the stock. Read that again. The President of the United States bought shares in a company, then posted about that company on social media to his tens of millions of followers. The stock moved, and the financial disclosure that revealed the purchase came after the post. This is the same pattern that would end a regular person's career on Wall Street. If a fund manager bought a stock and then sent a mass communication to millions of people telling them to look at it, the SEC would be at their office before lunch. It is called a pump and dump. It is illegal. It has been illegal for decades. And when it happens at the presidential level, using the bully pulpit of the most followed political account in America, it just becomes a news item that scrolls past your feed between a ceasefire update and a meme. The calendar is light this week, putting focus on rate hike fears as Kevin Warsh takes over at the Fed. Jerome Powell's term as chair officially ended Friday, May 15th. The most powerful economic position in the world just changed hands, and it changed hands in the same week that the market gave back its gains. The bond market hit its highest yields in nearly a year, and the Trump-Xi summit ended without a single concrete agreement. Let's go through the week because it was a masterclass in market whiplash. Monday, all-time highs. Jensen Huang on a plane to Beijing with Trump. The market celebrating the possibility of a China chip deal before anyone had confirmed a single term of any deal. Thursday, the Dow retook 5,000 on the back of strong Cisco earnings and summit optimism. The S&P 500 hit a fresh record close at 7501. The Nasdaq hit 26635. Champagne, green numbers everywhere. The AI trade is back. Everything is fine. Friday, Trump departed China after 2 days of talks with President Xi, accompanied by 16 top U.S. executives. He touted fantastic trade deals and said a lot of different problems had been resolved. But no major agreements or breakthroughs were announced before he left Beijing. No deal, no concrete terms, no signed agreement. 16 executives flew to Beijing and came home with what amounts to a very expensive photo opportunity at the Temple of Heaven, and the market responded accordingly. The S&P 500 fell 1.24% to 7408. The Nasdaq lost 1.54% to 26225. The Dow dropped 537 points to 49526. The Russell 2000 shed 2.44%. The entire week's gains, the all-time highs, the Dow 5000 celebration, the AI euphoria, largely evaporated in a single Friday session because the summit that was supposed to change everything changed nothing. Now let's talk about the number that is quietly becoming the most important financial story of 2026, and it is not the stock market, it is the bond market. The 10-year Treasury note yield spiked to 4.55%, the highest level in a year. The 30-year Treasury bond crossed 5.114%, its highest level since May 2025, and the probability of a Federal Reserve rate hike sometime this year climbed to 45%, according to the CME FedWatch tool. Just 1 month ago, the probability of a hike in 2026 was 1%, from 1% to 45% in 30 days. That is not a gradual shift in market expectations. That is a complete reversal of the interest rate narrative that was carrying every rate-sensitive asset in America. Mortgages, auto loans, corporate bonds, small business lending, every single one of them is priced off these Treasury yields. And when the 30-year crosses 5% and the market starts pricing a 45% chance of a rate hike under a brand new Fed chair who has never navigated a financial crisis at the helm, the financial math for millions of Americans changes overnight. Kevin Warsh comes into the Fed facing a big family fight over cutting rates. The Fed's internal divisions have never been more public. Some governors want to hold. One has already publicly suggested hiking. The new chair inherits 3.8% consumer inflation, 6% wholesale inflation, $109 oil, a frozen Strait of Hormuz, and a bond market screaming that it does not believe inflation is going away, and he has approximately 0 days of institutional credibility built up to navigate any of it. Here is the Berkshire story that cut through the noise this week, and it matters more than it sounds. Berkshire Hathaway returned to airlines with a $2.6 billion stake in Delta Airlines. This is the same Warren Buffett who famously sold every airline stock he owned during COVID and called airline investing a financial trap. The same Berkshire that has been sitting on $397 billion in cash for 3 years while selling everything. And now Greg Abel, Buffett's successor, just put $2.6 billion into Delta Airlines. Why does this matter? Because Delta is a direct play on oil prices normalizing. Airlines are among the most oil price-sensitive businesses on Earth, Every dollar drop in oil per barrel is hundreds of millions in savings for a major carrier. Berkshire buying Delta is not a tourism bet. It is a structured bet that oil prices come down significantly from current levels. It is the $397 billion cash pile making its first meaningful statement about where prices are heading. And when the world's most disciplined capital allocator puts $2.6 billion into an oil-sensitive asset, that is a signal worth paying attention to. Global oil stockpiles could hit record lows if the Strait of Hormuz remains closed. That warning came this week from energy analysts tracking the real-time supply situation. The futures market currently implies WTI crude falling from over $100 today to around $80 by December 2026 and below $75 by December 2027. The market believes oil comes down. Berkshire believes oil comes down. The question is whether the strait reopens fast enough for that projection to hold, or whether record low stockpiles arrive first and send oil to $120 before it ever sees $80. And then there is the Cerebras story, because this one tells you everything about where we are in the AI cycle. Cerebras systems surged 68% on its first day of trading, closing in on $100 billion in valuation for a company with a little more than $500 million in 2025 revenue. $100 billion valuation, $500 million in revenue. That is a price-to-revenue ratio of 200 times. Not earnings, revenue. The company does not have meaningful profits yet. It has a big number, a hot sector, and an IPO market so hungry for AI stories that it handed a $100 billion market cap to a company that most people outside of Silicon Valley had never heard of 72 hours earlier. Jim Cramer warned that SpaceX's upcoming IPO could be destructive for the rest of the market. When one IPO is large enough that analysts are warning it could drain capital from the rest of the market, you are no longer in a normal investment environment. You are in a late-stage mania where the size of the story matters more than the fundamentals underneath it. Here is the full picture as of today, Sunday, May 17, 2026. The Trump-Xi summit produced no deal. The market gave back its weekly gains on Friday. The 30-year Treasury is above 5%. Rate hike probability is at 45%. Kevin Warsh just became Fed chair with no runway and a fire already burning. Berkshire put $2.6 billion in Delta as a quiet bet that oil normalizes. Cerebras IPO'd at 200 times revenue and the market cheered. And the President of the United States bought Palantir, posted about it publicly, and the disclosure came after the pump. This is the market you are investing in right now. It is not broken. It is not fraudulent in any simple sense. It is just operating at a level of complexity, contradiction, and concentrated power where the rules that protect regular investors feel increasingly theoretical. So here is what I want to know. Does the bond market at 5% and 45% rate hike odds finally crack the tech rally that has held everything up since March? Or does Warsh find a way to thread the needle between inflation and growth without hiking, and the market shrugs off everything and hits new records again by June? Drop it in the comments, because this week proved that in 2026, the most important financial decisions are being made by a handful of people, and the rest of us are just reacting to their tweets.